Welcome in. I hope each one of you are doing great, being secure under the current turbulences that we're experiencing across the board. Today, we're going to navigate the S&P 500 strictly through the lens of risk management. Not predictions, not opinions, just what the structure is telling us right here, right now. And it's been telling us since December and October also from 2025, a trading range. I hope that you guys know that the goal of this stream isn't to tell you where the market has to go, as many other people are telling you, but rather is to show where the risk is defined, where it may expand, and where it's invalidated after or based on the current patterns developing on the S&P 500. Many of you know that markets don't necessarily hurt unless you're on the wrong side of the trade, right? They also don't hurt because they move. They normally hurt because traders don't have their risk respected. So that's exactly what we're going to be focusing on today. Before we even talk about direction, I want to establish something important. If you do not know where you're wrong, then you don't have a trade. Right now, what matters isn't the headlines or the next catalyst per se. It's how price is behaving relative to structure and how it's been trading within the same trading range since October, despite the slight new all-time high by a few points. However, the trading range has been defined. We went over these levels based on the potential Wyckoff distribution schematic that we already navigated. Once it breaks, you guys know that risk shift, not because of emotion, but because of the pattern fails. However, many of you know that patterns don't fail loudly. They fail quietly, one level at a time. You guys hear me repeating over and over, levels by levels. Why? Because if one level fails, we move into the next one, respecting the levels. Many of you also know that risk management is not a stop-loss number, it's a structural decision. If price holds key levels, risk is defined. If those levels fail, then the bias changes or the exposure is reduced. No ego, no forcing trades, my friends, okay? You guys know that the best traders are not the best predictors. They're not trying to compete being the next Nostradamus. The best traders, they're best at risk management. You don't need certainty, you need clarity. Now, from here, we have two primary scenarios where we navigated these levels before. However, if the patterns hold, we respect the structure and manage exposure. If the pattern fails, it opens up for risk and then we reassess, not react. So this is how we stay aligned with the market. Case in point, you guys know that Bitcoin is currently trading at 67, printed a new low at 66,000 today from our previous projection. Only to bring a case in point here that if you were extremely hyped at those highs, right, in the upper 100, 120s, expecting higher levels based on Wall Street analysts or any other influencer or fee influencer that you may follow, now you're looking behind in retrospect from July 16, my friend, only in the past 6-7 months, looking at the current levels, okay, July 16, you're looking now, where do you stand based on risk management? You are underwater. Unfortunately, this is often the case among influencers in the crypto space mainly, and I hope this serves as a lesson, only to prove a point that many in the space clearly have no clue what trading is about, let alone what the market will do next, and also let alone about risk management. This is not just buy and hold. This is know when those key turning points may present themselves. So now moving back into the S&P 500, because this is our topic for today. You guys know that we mentioned that on October of last year, there was a high already presented on the futures contract for the month of March. That printed a high of 7,000. However, prices were unable and are still unable to break or to leave this current trading range. Okay, many in the space are saying, oh, I told you, new all-time high. Sure, my friends, new all-time high, but where is the risk? How many points above we are from those levels? Okay, is it really any different from the previous high of October at current highs? Not necessarily. So my point here is that based on the arguments that I already presented on the previous stream for the S&P 500, is that in my opinion, okay, none of these of course represent any financial advice, but in my opinion, the S&P 500 may be within a Wyckoff distribution. Okay, this is why we have Charles Dow on my left hand side, on my right hand side, Mr. Richard Wyckoff. And I'm going to bring the two arguments as to why. First, clearly a trading range that the S&P continues to be in, and some resistance are being presented at current highs. Now, on the macro, many of you are already know or are already familiar with our main projection from 2022, correct? This is getting boring. However, it is extremely important to bring context. From those lows, the risk towards the upside was higher or lower in this case, right? To be extremely bullish. At these highs, we mentioned many times after the first test into the 61 from the lows of 3,800 to 4,000 from 2022, that was a directional bias to reach and test those levels. However, once we reach those levels, we then experience the next severe decline, 22% decline. I mentioned also that after recapturing the previous high, after the previous 22%, why this also comes as an important level. Because at these highs, many were expecting also higher levels at these highs. What occurred, we first reversed towards the downside and then we went higher. So market participants who were expecting higher levels at these highs back in December 2024 at these highs and also February 2025 potentially already left the market with a loss, unless of course you were able to capture these levels. Many did, but many of them also left because their expectations were higher at these highs. Okay, and now we are slightly higher. But the risk to me is, once again, based on another reading, that a Wyckoff distribution may indeed be presented here. Another argument based on harmonic structure is the bearish shark pattern. Okay, many of you who are familiar with this type of trading strategy or method are familiar that first there's a reactive move, correct, at the type 1, the first test, then another test as a confirmation, a type 2 return, potentially also presented as basically a double top, right? Simple as that, my friend. A double top, clearly. Triple top if you want to call it, okay? However, we can observe also that prices are unable to breach higher, remaining within the trading range. So in my opinion, the risk at these levels, in my particular opinion, once again, is that we may go lower. Okay, this is not an area for me to be extremely bullish, just out of the blue, telling market participants that we may go to 8,000 or 10,000. Keep in mind the case in point on Bitcoin, where we are now, and what the expectation of many was before. To me, we are at a risk levels. And of course, if there is further downward pressure on the S&P, this will likely also take the price on Bitcoin slightly lower. We have levels. Our first levels from, once again, December or July of 2025 was to test 65,000. Where did we go today, my friends? 66. Are we going to test the next deepest level of retracement at 57,500? So keep these levels in mind. The S&P hasn't really corrected much yet, remaining potentially still within the range of the upthrust after distribution. And what follows after is the last point of supply up until the previous sign of weakness at 5,500. Once these levels break, you guys have the measure move pretty much of this entire trading range. Okay? So please erase all the noise that you were following, if you were following others, without any proper adjusted levels. Okay? Risk management first rather than hype. To me, once again, the risk here is to the downside. All right, everyone, this is going to be a very brief stream here for the S&P 500. Basically, no major changes since our previous technical proposition. However, I want to mention that there are patterns in between on minor time frames, such as the hourly and the 4-hour, that may present here and continue within the range. There's also another timing factor. I'm looking for April and May, mainly for the S&P 500 in particular. Okay, so my friends, from here on, I'm already in a short position for the S&P 500, 59.53. And from here on, if it goes back into a range, I know where my risk is determined. Okay, I have the levels. If it goes back into those levels, I exit, re-enter. We have been doing this pretty much since the previous short, 59.63, went higher or lower first, went back above, and now we're back below it another 100 points. On futures, you guys know this is massive. Everyone, let's see what the market will present next. And I hope you are filtering out the noise from many charlatans in the space. Remember to live a life with an attitude of gratitude, and I'll see you guys in the next one. Remember also to respect the market. Cheers.